The markets have opened and it's looking like a great day for Tesla, up around 5% so far, but our focus is going to be on the pharma giant Novo Nordisk, which reported their earnings before the market opened on Wednesday. And when we do take a look at this company, over the last 6 months they have been struggling, down around 15%, and we also note they are trading at the lower end of the 52-week range. So is this one we should consider? When we have looked at this company, very high quality metrics, and there is also large upside that Wall Street see over the next year. So we can take a look. Now their earnings does say that on Wednesday when they reported, their shares were up around 8%, although we can see they have still struggled and are trading towards the lower end of the 52-week range. When we take a look, their net profit for the quarter was marginally higher, 27.3 billion, than what analysts were expecting at 26.95, although a beat is a beat nonetheless. And when we look at their guidance for the full year 2024, they've just narrowed it from 22 to 28 to 23 to 27%, so not much to talk about there. But one of the highlights for Novo Nordisk this quarter has been that their sales of Wegovy are up 79% higher in Q3 2024 than the same comparative number in Q3 2023. So let's take a little bit of a further look, and in terms of their net profit, as we already mentioned, coming up marginally higher than what the markets were anticipating. In terms of Wegovy, well, 79% higher is very, very strong. That brought in 17.3 billion for this company, and analysts were only expecting 15.9, so a very strong performance with that part of their top line revenue. We have mentioned in terms of their top line revenue, they have narrowed it, and they've done essentially the same thing to their operating profit guidance, now expecting 21 to 27% as opposed to the 20 to 28. Now, a lot of the growth that we have seen come from this company has come from the GLP-1 based products. As we can see, both Ozempic and Wegovy have really helped companies like Novo Nordisk. As we can see, they are the market leader with around 53.9% in terms of the monthly prescriptions. Now, in terms of their top line revenue, it is up around 22% in North America for that Q3 comparative. And as we said, a lot of this top line growth is being driven from the GLP-1, which the volume itself is up 15%. Now, they have had a lot of competition that has been talked about being a really big issue for this company, but as we have seen from their results, they have battled this and they are coming out on top. And we also have a fairly positive piece of information here that a study that was performed in October showed that Ozempic could reduce the risk of developing Alzheimer's disease, which in essence at a bare minimum helps to delay this issue, or what they are saying, potentially preventing the memory robbing condition. So overall, it did look like a good earnings. However, as we have noticed, over the last 6 months, they are down around 16%. Year to date, this company is up only marginally 3.4%, so severely underperformed the S&P. Over the last year, again, very poor performance. But when we zoom out, over the last 10, they're up 388%, so they have significantly outperformed the S&P. And if you do include the dividends on top, your return would be marginally higher. As we can see, the yield itself right now around 1.34%, and we'll do some comparative to the 5-year average. Now, even with the drop, it is still trading at a fairly expensive forward P of 33, so we'll compare that to the sector, but the S&P itself trading around 25. In terms of Wall Street, well, they consider this a buy. However, we are noting both Seeking Alpha and Quant giving this company a hold. Let's also take a look at some of their investor presentation slides. Very important to note. So we're comparing the first 9 months of 2024 versus the first 9 months of 2023. First thing to mention, their top line is up 23%, so great to see. Their gross margin is up marginally to 84.6% from 84.5%. Then we look at their operating profit. Whilst it is up around 21%, we do in fact see the actual margin itself is down around 1 percentage point to 44.7%, but overall net profit as well as earnings per share both up strong double digit, 18% and 19% respectively. Then we look at their forward guidance for the full year of 2024. We've already mentioned this, but if you do want to see, their top line revenue growth has been narrowed against the previous expectations in August, and the same to be said for the operating growth, but it is a little bit clearer from this slide. Now, two other pieces of information that we do want to briefly touch upon. We can see here Deutsche Bank in fact have cut their stock target for this company, although they do maintain that it is a buy rating based on their latest earnings, and when we get to the detail, they've dropped their target by around 10%. And as we said, when we get to our own valuation today, we will run through the numbers. The other thing that we do want to report, we typically like to look at insider buying, insider selling, and we can see just on the 8th of November, so we are talking about in fact today, one of the boards, as we can see here, has released that they have bought around 1,400 shares, and this ultimately, when you want to do the math, comes around $150,000. Now, we do typically talk about insider buying as a bullish signal, as management typically buy because they believe the share price will go up. So that is the information if you do want to take note for your overall investment thesis. Now, look at the same piece of information, however, for the institutions, we can see around 11.5% in terms of holdings, 2.61 billion worth of sales by the insiders over the last year, with nearly 4 times as much buying in the same time frame, 8.4 billion. And we also note over the last 4 quarters, institutions are also buying more than they are selling. So clearly very bullish on Novo Nordisk, but as always, do your own due diligence, never copy what insiders or institutions do. Now, we also want to let you know we have released our latest free weekly article where we talk about 2 stocks we are buying in the month of November. So do click below, sign up, and you can read these articles straight away. We deliver one to your inbox every Monday morning, talking about severely undervalued stocks that we believe deserve your attention, as well as what's gone in the market over the last few days. On top of that, you can grab a copy of 40 undervalued stocks for the month of November. Lots of information for each one, as well as the upside that Wall Street themselves see over the next year. And on top of that, you can grab a copy of 22 undervalued stocks that Wall Street themselves believe have the most upside out of the S&P 500 right now. So click below, sign up, and you can read straight away. The other thing to look at is their earnings. Now, they have reported Q3, which as we saw was a good beat, but we do notice the previous quarter in Q2 they did have a miss. So out of the last 4 quarters, they have around a 75% track record. Whether or not you believe in their historical forecasting accuracy, we can see over the next full year, they expect their earnings per share just under 4, bringing that forward P to around 27. We also notice the next quarter, so the final for 2024, they're anticipating 26.5% to the EPS on a year-on-year comparative. So it looks good, lowering down that forward P, which currently does look a little bit costly, but we're going to compare that now to their 5-year averages. Now, first thing, they have a dividend safety score, 99, very safe, in fact the highest score obtainable. We're going to compare it on these 2 models, and they've increased the dividend over the last full year at 52%, something we love to see, however fairly rare on this channel. Now, in terms of the safety score, well, reaffirmed a few months ago, ultimately meaning a dividend cut is highly unlikely. And when we get to the key metrics from the last recession, the 07-09 crash, they increased the dividend. They had plus 6% sales, well above the average of the S&P, which was a negative 12, and they also significantly outperformed the S&P itself, negative 27 versus the S&P's negative 55. Now, beautiful dividend growth as we've seen over the last full year, but the same to be re-emphasized over the last 5 and the last 20 years with an average of 21% year on year. They are also a dividend aristocrat with more than 25 years of consecutively increasing the dividend. We then move on to this valuation metric, which does look at the 5-year average of the forward P. And over the last 12 months, we can see with the blue indicating the fair value, the intrinsic price, pretty much the majority of the year has been overvalued based on this model. Right now we see it enter the fair value and in fact coming towards the lower end, so you could argue reasonable valuation / undervaluation. Remember though, we're not looking at any one of these models in isolation. We will conclude towards the end. Then we get to dividend yield theory, where it states a company is undervalued when the current yield sits above the 5-year average. Right now, 1.34, not far off the 5-year, so based on this, reasonable valuation. And based on the forward PE, 28 is marginally lower than the 5-year of 30.4, so again, another reasonable / slight undervaluation metric. We do, however, note it is significantly higher than healthcare's 16.8, but remember, it does trade at a premium. Does it deserve to be? I think so personally, but we will also compare it to the sector to come to a conclusion. In terms of the free cash flow payout, which is the metric we use on the channel, earnings susceptible to manipulation by management through accounting, below 60% is what we want. Now, it's straddled around that on a year-on-year basis, and remember, we use 60%. We believe if it's lower than that, management can offer double-digit increases, which NVO have typically done. Now, 60% in 23, 51 over the next 12 months, so we do anticipate a nice increase to the dividend, double-digit at a bare minimum. Then we get to free cash flow, where we want consistent increases over the longer term. Tripled over the last 10 years, whilst inconsistent on a year-on-year basis. Nonetheless, growth is shown, and we can see it is expected to continue the upward trajectory over the next 12 months. Now, sales growth minimum 3 to 7%. We are seeing very strong numbers over the last 10 years, although there was a period where it was flat for 17 to 18. We do also notice the last 2 years looking very good, and on a trailing 12-month basis, and based on what we just saw in the investor presentation, we do anticipate that to continue, as we can see 23 to 27% for the full year. Then when we move on to looking at it from a numerical standpoint, we can see it has more than doubled from 2014 to 2023. And what they also like to do are share buybacks. As we can see, outstanding shares has been reducing below, returning excess cash to investor pockets, something they do year on year, fairly marginal, but still a nice bonus to the investor. Then we get to the ROIC, one of the best ever that we have seen on this channel, and this is a very, very important metric. We want 10% or more to give us faith management are able to effectively allocate their capital. Just look at that, the lowest over the last 10 years is 58%. 99% of companies you look at won't even reach that over the last 10, so do check it out if you want to verify your own portfolio. 72% in 2023, 64% on a trailing 12-month basis, looking incredibly strong for investors as well as those potential who want to consider adding. Operating margin, very strong and consistently well above the minimum, 39 to 45, so you could argue some operating efficiency. And no worries whatsoever with that free cash flow margin, looking absolutely beautiful, around the 30% on a year-on-year basis. Then we get to the net debt to EBITDA, again looking absolutely strong. EBITDA, earnings before interest, tax, depreciation, amortization, below 3 consistently, and with the numbers below reflecting the number of years it would take the company to pay off all of their debt net of cash on hand. Very small over the last 3 years, 0 over the next 12 months. So their balance sheet, given this does correlate to dividend safety and balance sheet, must be very strong. Won't even take them, based on the trailing 12 month, 1 day to pay off all of their debt net of cash on hand. And no surprises why this dividend safety score is the highest obtainable at 99. Then we're going to take a look at the income statement. We have covered their top line revenue. As we said, very good growth over the last 10 years, and that is shown again in the graphical format. But we want to understand, does the bottom line give us that same information? And we can see pretty much yes, it has increased over the last 10 years, maybe a little bit inconsistent. Nonetheless, pretty much tripled from 4.3 billion in 2014 to 12.4 in 2023. Then we get to the balance sheet, which we already mentioned looks very strong. In fact, on the trailing 12 month, won't even take them 1 day to pay off all of their debt net of cash on hand. And we can see from the graphical format, their cash has been increasing over the longer term. 2.6 billion in 2014, 11.2 in the latest quarter. Remember, one number, whether it's the cash, their debt, or anything in here, won't tell us anything, which is why we compare it to their total debt numerically and directionally. And even though it has been increasing over the longer term from 117 million to 8.5 billion in the latest quarter, their cash position is still much higher, and as we've already mentioned, won't take them even 1 day to pay off all of their debt net of cash on hand. Now, valuation grade at D- is no surprise. We already showed you that it does trade higher than the sector, 33 versus the sector median of 21, which means if you're buying this company right now, you are paying a 57% premium, and that is shown no matter what valuation metric you use. Now, we do believe it does deserve a premium. How much? Probably something to cover in the margin of safety in the valuation shortly. But look, their growth grade is A. That is 26% year on year versus the sector of 7. They're forward looking around 24%, a lot better than the sector of 8.3%. And when we get to the earnings per share over the next 5 years, anticipated 15% year on year, as we can see, sector around 11.2. We also notice their profitability is absolutely phenomenal in comparison to the sector. 85% gross margin versus 59% from the sector median. Bottom line, 35% when actually the sector itself is negative 4%, and their cash from operations blowing everyone out around 18 billion over the last 12 months. Again, sector median negative 14 million. So a quick recap for this part of the analysis: just one buy rating from Wall Street with a hold from Seeking Alpha and Quant, D- on valuation, A on growth with an A+ on profitability. Now, before we jump into our valuation, let's have a quick comparative against others in the sector. Johnson & Johnson, Merck & Co. We talked about many of these, Eli Lilly as well. Total return, including dividends reinvested over the last 12 months, one of the worst performing, NVO at only 6%. We can see though, half of these have performed as mediocre, but there are one or two that have performed very strongly, and even Eli Lilly, as we've already covered, it did drop after their earnings, still up around 33%, the best performing. Now over the last 5 years, when we do zoom out, we can see NVO the second best, up 309%, Eli Lilly though at the top at 676%, and over the last 10 years, we can see again pretty much the same story to be told, up 495%, which is very strong, but remember the past performance of this or any other company does not dictate their future performance. Finally then, we just want to reflect that on the S&P, it has outperformed over the last 12 months. However, over the last 5 years and over the last 10 years, we can see NVO, with reinvesting those dividends, has massively outperformed. Lots to consider, especially if you believe it can continue to outperform, then it may be a good choice for the portfolio at the price, or maybe you believe the S&P from this point on will outperform, so you could consider a low-cost ETF. Now let's jump into the intrinsic value. As always, if you do enjoy the content, value is being provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. So intrinsic value of $134, got it through the DCF model, but we have the free cash flow year on year, average growth rate around 11%. Now we've gone for 16% around management targets, and we have a low, medium and high. Now with the 16%, based on the discount rate, we get the present value of future free cash flows and terminal value, add together with the cash, subtract total debt, get to the equity value, divide by the shares outstanding, and as we can see, the intrinsic value giving an undervaluation signal with 25% upside. Now remember, these numbers are subjective and you can grab a copy of this model by clicking on the pinned comment below, running through your own numbers, whether it's for NVO or any other company. But just to show you for transparency, if you believe 14% is more appropriate, intrinsic value 117, 9% upside, and for those that want to be more optimistic at the 18% point, $154, 44%. Taking it through though, with our margin of safety, we will take the median rate of 16%, where we get the 134, and we do like to always start off with 10%. Use that if it meets our 3 golden criteria: wide moat, strong financial metrics, and good forward-looking data. If you believe that in today's episode, a buy at $121, then we keep going till it's near the current trading price. And what we are saying right now is if you are looking to buy this company, it gives you a 20% MOS based on the free cash flow growth of 16% year on year. And for those that want to see at around the 25%, around $100. Now this is a high quality company, and I do believe if it comes around to the 25% MOS level, it is a good consideration around the $100 mark. However, there will be other people who will dollar cost average in, or maybe believe at $107 right now, definitely one for the portfolio. Lots to consider, although Wall Street are very bullish, 154 price target, they see upside of 44%. What this indicates to us, that is pretty much the same at the 18% level, so they see their future free cash flows growing at 18% year on year. As always, give us your thoughts in the comments below. 20% MOS, 44% upside. Is it a buy, hold or sell? If you enjoyed the episode, smash that like button, hit that subscribe and bell button. Don't forget to sign up to the free weekly newsletter below, and come and join us in the Patreon where we do talk about our weekly buys and sells. As always, have a great day, and we'll see you all on the next one.